30-year career, almost all of it spent in self-storage, and he's amassed incredible credibility. This week on Stories Behind the Door podcast, the Senior Vice President of Asset Management and Development at SafeGuard Self-Storage, Stan Bonilla. You know you've made it in your industry when the people around you refer to you by one name, maybe throw on a nickname, and today's guest personifies that. Really excited to have a second go-around on the podcast, but our first time on Stories Behind the Door with our sponsor. Really excited to talk about Kiwi 2 Construction. Wayne Woolsey and his team, 30-plus years in the steel building world. Simply the best crews. If you're building something, get in touch with them early. Get a great idea of what the best in steel looks like. You can touch base with them at kiwiconstruction.com. Well, he's Stan the Man, the Senior Vice President of Asset Management and Development at SafeGuard Self-Storage. So kind enough. First of all, thank you. As I told you off air, I had a person who was scheduled for today. They had a life event that kind of got them off schedule, and you were able to step in, which was so exciting to me. I haven't stopped smiling since you agreed to come on. We got a ton to talk about, but thank you for taking the time on a Friday afternoon to come and chat with me.
My pleasure. Always anything I can do to help Thaddeus, I'm happy to spend the time and chat away.
I love that. And we're going to talk about that because you've been that way since way before I even had a podcast, and you're the way that you treat people and the kindness in the industry. Probably why everyone calls you Stan the Man, which is pretty cool.
It also rhymes.
I'll start this. that doesn't hurt. That doesn't hurt. But there's a whole lot of people that have things that could rhyme with their name that they don't get referred to as kindly as you do. Podcast always starts the same, and I know you were on a year ago and shared a little bit of your journey of getting into self-storage, but give me the abridged version of how Stan Bonilla ends up at SafeGuard Self-Storage.
Okay, I'm going to fast forward it. I was out of the industry for a few years, and I got into corporate real estate management, and that was an interesting journey during the recession. I was managing a portfolio for a group called Adecco. They're the largest employment management service in the world. And I was managing their North American portfolio, which was pretty interesting. A lot of burn and churn. And they decided to move down to Jacksonville, asked me if I wanted to go down there with them. And I had a quick answer. It was no. I did not ever expect. I started in the industry in 97. And in 2007, I joined Adecco, and fast forward to 2013, they moved down to Jacksonville. Jim Goonan over at SafeGuard got word that I was available, that I was no longer with the Adecco guys. He reached out to me. I had already come pretty close to taking another job. We sat down, had a great lunch. And at the end of the lunch, he said, Stan, if you don't take this job, I'm explaining it to you wrong. And here we are 12 years later, and it was the right decision.
Let's talk about that. As you look back over the last 12 years, how thankful are you to have ended? I talk about this all the time, and you and I talk about it, what a special industry we work in. Did you know what you were getting into when you took the job?
I did. I've known Jim for a long time, and I knew SafeGuard, and the industry is such where you don't just compete with people, but you spend a lot of time with them, and even your competitors. It's a very collegial industry, and we had an opportunity to get to know each other and knew each other on the friend side more than the work side. And when he reached out to me, I was very happy to hear from him again. I had no intention of getting back into storage at this time. And the opportunity was right. The timing was perfect. And here I am. Things work out the way they ought to work out, I believe.
So 12 years, you start in 2013. Obviously, we started to see the shift, 17, 18, 19. Everyone's gung-ho about storage. People are building developments left, right, and center. COVID put a little burp there, but it came right back. 23, 24, very different, right? A little different. Now we're in 26. Talk to me about the cycle. Where does Stan Bonilla see us in the cycle of what's going on? Have we passed the bottom? Are we still kind of treading water? What do you see?
So this is a very different cycle than we've seen in years past. And I'm not completely surprised. The last economic growth cycle that we've had was the longest period of economic growth without a recession that we had ever had in the history of the United States, which is saying something, right? When COVID came, that was a crash that was imposed on us. But in a sense, it was the economy needed to be reset. At the same time, trillions and trillions of dollars were pumped into the economy to soften the blow. Well, it may have softened the blow, but it also, I think, in retrospect, is stalling the recovery. We never, in times past, at the economic forum this year in San Antonio, we had a fantastic, if you were there, it was a really good economist, and he was showing all the stats of previous step backs in the economy where we go into recession, and you have growth, and then recession, growth, and then recession. This time we've had a very long growth and no recession, but a slowing of the economy. And in the history since the 70s, we haven't seen a slow decline in the economy. So that's a little bit different right there. And again, it's causing a little bit of a malaise now, because where are we? We thought we'd be out by now. In 2024, we were saying survive till 25. Here it is 2026, and the dynamics really haven't changed very much. We're so tied to the housing market, and mortgages haven't come down yet. I think when mortgages do come down, mortgage rates do come down, we're going to see that boom. But at the same time, it is helping us a little bit because we were oversupplied. So, and what I love about self-storage, it's economics 101, the simplest line between supply and demand. Demand goes up, your rates go up. Supply goes up, rates go down. So right now, we're still absorbing a lot of that oversupply that came into the market. We're seeing it now. And at the same time, without being too disparaging, there are factors in the market that are driving down rates, and that is management driven. So that management driven driving down rates, in a sense, is not necessarily a bad thing for the overall system in that we're working within in storage, because we're allowing ourselves to absorb some of that oversupply. Once that oversupply gets absorbed and maybe some of the pricing policies change, we can start to build up again. So I think we're close to the end. I'm starting to see green shoots. Of course, I'm a developer at heart, and developers at heart have to be optimists. You can't survive in this business unless you're an optimist. So as an optimist, I see green shoots everywhere. I'm starting to see in certain markets where things are coming closer to penciling. There's still guys out there that are putting shovels in the ground. It's SafeGuard is a little bit more conservative than most. We are not fee driven at all, so we're not looking to make our money up front. We're long-term holders, and as long-term holders, we wait for the market to catch up a little bit more so than many of the other developers may be doing.
Do me a favor, because not everyone necessarily understands your structure. It's so unique in the self-storage game. Kind of give the 10,000-foot view of how your storage is set up and how it operates.
Sure. So there, we're kind of in the in-between level of owners, managers. We're an owner manager. So we own the properties long-term, we hold them, and we manage the properties. We're not a public REIT. We are wholly owned by a fund managed by Morgan Stanley that operates like a REIT. It's a privately held REIT. It's mostly pension funds and insurance funds, very large investors, in other words, that are the ownership. Not a lot of owners. I think under 300 owners of share in it, and it's $45 billion REIT fund. We are the small part of that fund. We're about 5% of that fund, which is a comfortable place to be. And we're still growing pretty well with the fund as the fund grows. But it is unique in that there are investors trying to get in. So we don't have any debt. We fund everything with cash. That actually works against getting new investors into the fund. So it allows us to be all cash buyers and acting very quickly. I'll give you an example. In December, we were able to go to contract on a deal. The seller had to close for financing reasons before January 1st. We signed the contract on December 5th and we closed on December 24th, $40 million. So we were, it was a lot of work, happy to do it, but it's what we do.
Yeah, if you're running a company where you're going out and raising equity on that purchase, it's almost impossible to get that done in that period of time, just because you got to go show your equity what the deal is. Yeah. I want you to give people an idea, because you alluded to it a little bit, but the buy-in on the fund for SafeGuard is an insane number. Tell me what it costs someone if they want to buy into this fund.
So I'm not forward facing on that side of it. But
all right, good. Then don't tell me.
Yeah, it's large multiples.
It's a number that is really significant. But to your point, it's not typically an individual investor who's buying into this fund. All right, I'm sorry I put you on the spot there. I want to talk about a couple of things that are going on in the industry this year that are, to me, are blowing my mind. Right, in March, Public Storage announces they're acquiring NSA, expected to close third quarter. $10.5 billion deal. They're paying a 35% premium on stock price for that purchase. Their belief, of course, that their branding, their ability to they think they're going to save $120 to $130 million a year by streamlining the two operations. They were willing to pay a significant premium. What blew my mind was last week, they go and raise another $500 million selling bonds at 5%. Like, what signal? And by the way, Storage Mart, another privately held REIT, earlier this year, $1 billion acquisition of 15 assets in New York City across 4 of the boroughs. Extra Space and CubeSmart last year announced joint ventures. I guess CubeSmart's was this year. They announced it. I think Extras is $600 million. Cubes is $250 million. SmartStop last summer, $500 million in Canadian Maple bonds. What do you take of all this capital that's being raised by the different publicly traded REITs, the action that the private REIT, Storage Mart, is taking? What is this signal for where storage is at?
There's a lot of capital out there slushing around, looking for a home. People recognize that money recognizes that storage still gives a pretty good return. 5% bonds is a little scary considering what Public Storage just bought NSA for, or what they're slated to buy that for, because I'm not sure that that's a 5 cap at the end of the day on trailing 12. They really have to do a lot of work to bring that forward to be able to pay for that. Now, of course, that those bonds aren't paying for that purchase. That was purchased through other means. But if you're going to use that as a benchmark, you really have to have a lot of faith in your operations. And Public Storage operates. They've been around the block. They know what they're doing. They're great operators. They have their own systems that are unique to them and really manage it tightly. But you have to, execution becomes essential in that case. The overall market, like I said, going back to COVID and trillions of dollars getting into the economy, a lot of that, pushed right up to the top and to the top lines, and a lot of these institutional investors, and they're looking for homes, and where are you going to put that money right now that's giving you those returns? So the difficulty is that they are looking for those returns. So what happens, you have all this money sitting on the sidelines waiting to crash in, which is a little concerning because when the market does turn, what's going to happen, right? You're going to have all of a sudden a rush into the market again, and we'll be oversupplied in 3 years and we'll have another pullback. That's real estate though. That's the way the real estate ball tumbles.
I was going to ask you about this. Obviously, S3 Partners, we made our bones. Barry Sherman's been involved in 330 ground up self storage developments, which is a number that still boggles my mind. But, that's
Boggling.
going back to
Mind boggling.
1992.
Yeah.
34 years of doing self storage. So we struggle with this and we talk about this internally all the time, like this idea that, man, there needs to be a pullback in ground up development, right? But do we have to be the ones who pull back? And that's kind of where you get into this battle with yourself, right? From Stan Bonilla's perspective, how much of a pullback do we need? And how long is it going to take for some of these markets? We've seen, who would have thought that Boston, Massachusetts would be outperforming, places in Florida with 10+% growth rate every year. Boston's negative growth rate, and yet storage is doing better there. So what do you see here, and what do you think is how much of a pullback do we need on the development side?
There's a lot to unpack right there in that few statements that you had there. And I'll use what we're doing at SafeGuard as an example. So we've pivoted. We built our 90 properties primarily through development, and we love development and we love our assets that we do develop, but it has to make sense. We still have to deploy capital. So what have we done? We've pivoted toward acquisitions. So we are much more focused on acquisitions now than on development. Development pipeline is very thin. We're still looking. And like I said, there are some green shoots that I'm seeing. It's very market specific, and it is filling in the donor holes. We have to be very careful not to oversupply. I think we get into trouble from the individual merchant developers, which is fueled by the third party management. That was a new trend that really led to the oversupply. Once upon a time, if you built the property, you either had to sell it or manage it yourself. Now with the public companies and the large holders like StoreQuest, for instance, does a great third party management that allows merchant developers to build multiple properties and turn it over to a third party management and manage it. That really caused an explosion in that industry. It's still now a lot more difficult to do that. Still some concern about merchant developers working on a fee base or not necessarily doing the best deals. A problem, or I guess what's the word? The risk of the third party managers looking at a development. They have no dollars to risk. They want the management fee. So the danger is that they say, yeah, do it. We'll manage it. It's a great deal, when it may not be such a good deal, but they're going to get the management fee and they have nothing to lose. I have faith that there are good actors out there for the most part, but there's a tendency to overextend yourself. So that's always a danger. I think a few more years, like we said, of that slow development, very precise development. But let me shift to where we're seeing deals be made. The Storage Mart deal, I think, is a great case study of where the industry is headed. Storage Mart has end of the funnel capital. They have big dollars to buy big things, but they aren't always going out there buying onesies, twosies to add to the portfolio. They're going out, they are, but really where they're moving the needle is buying the portfolios. Now the portfolio, they bought that from Carlisle. Carlisle didn't develop all those either. They were buying from the merchant developers. So the merchant developers, the guys like Stan and Thaddeus, go out, put a shovel on the ground, build a property, sell it to a group like Carlisle. Carlisle aggregates a number of assets and then sells it at a better multiple to the end game, the public company or the private REIT. It's an efficient way to go, and it's the way that where the industry is growing, and it's the way the capital is flowing all the way down to the street. It's a really great case study that way.
I think it's interesting. And you mentioned merchant developers, and listen, you know how I got into the industry. I was running shovel ready storage back when I first got into the
Yeah,
industry, and I
yeah.
was living off of merchant developers, assigning raw pieces of land to them. And it's been interesting for me. And quite frankly, it's been a little humbling. And as I look back to my journey, and look, I'm not going to beat myself up too bad because I didn't know what I didn't know. But in looking back to, quite frankly, some of those merchant developers are in a really rough spot. You know, a couple of them that bought parcels that they couldn't get out of the ground because the banking rules changed, obviously, in 2023 with the interest rate changes, and then SVP and Signature going out of business. So I guess there's a question in here, which is, will the market take care of the market?
Optimistically speaking, yes, I believe it will. Every time there's been a pullback in the industry has clawed back. We've been flat for a long time now. Revenue has been flat for a long time. Occupancy has had significant headwinds for a long time for multiple reasons: interest rates, pricing strategy, consumer affordability, right? Affordability is a real thing today. If you look at any of the polls, that's the thing that people care about the most. And when it's time to make decisions between storage or paying your kids tuition or childcare, all of a sudden the garbage becomes our biggest competitor. So it's a challenge. Uh, the the tie to the mortgage rate is everything, though. That turns, and that will turn the tide, and we're going to see a lot more action going on the development side. When rates come up, and remember, everything's tied to rates on development. You have to have the rate there in order to be able to build your product. Safeguard products, I'm not even looking at markets under now. It's up to like $28 a foot rental rates. If it's not $28 a foot, it's just not penciling. Gives us very few
Yeah.
markets to look at, which is fine because that's where
Yeah.
we're in. Those are our
You,
markets.
you narrow it down for sure. I'm going to pivot a little bit. You mentioned the investment forum. Obviously, for
Yeah.
those that don't know, Stan, a member of the board of the New York Self Storage Association. With the consolidation that's going on, listen, there's 70,000 facilities in the US, maybe roughly 1,000 getting built a year. The big boys are eating those up at a quicker pace than they ever have before. How much more important are the state and regional SSAs right now, given what we've seen from legislative pressures? We just had the legal challenge. Extra Space was the only one on the lawsuit, but they certainly,
This time.
there could have
This
been
time.
more than Extra Space that were on the
Right.
lawsuit. Let's put it that way. Our friends at Extra Space sort of bore the brunt of that for whatever reason. Who knows why it was just them? But my question is, how important is it for the people that are involved in the industry to go get involved?
It's essential. I've been in the industry with the exception of that short window when I stepped out since 1997. I've been involved with the national SSA and now New York State SSA on the board that entire time. And really, you said it. There's multiple benefits from the associations. The networking is tremendous. Being able to get plugged into a lot of great vendors is tremendous. As a deal guy, understanding who's out there and who's building that networking side and deal flow side is tremendous for me. As a merchant developer, it's an opportunity to find that end of funnel and speak to somebody at the end of funnel side, like a Safeguard or a Storage Mart, that you wouldn't otherwise have opportunity to speak to. The other side of that is that legislative side is so important. Especially now in New York City, a lot of the blue states, particularly, are very anti self-storage. For whatever reason, we're looked at in a very negative light. And it's a great misconception of it. But misconception, perception is reality, right? If we're perceived as a bad guy, we're going to be treated as a bad guy. So what the association allows us to do is give us a unified voice to change that perception with our legislators, which is something that at New York State we're doing all the time, every day. We have James Coakley, who you'll have on here again soon. He is leading the charge for the New York State SSA, doing an amazing job there in front of our legislators all the time, who are coming up with crazier and crazier laws across the board, from rent control, which would put us out of business because they're not going to control their tax increases. Our expenses aren't going to be capped, but they want to cap what we could charge our customers. Nobody wants.
Mention that because it's not a like, I think in the rent control law in California, it's like a 5 or 7% a year rate increase. That's not what's on the agenda in the New York City Council.
New York City Council got crazy. They were talking about like a 2% rent increase, which it didn't pass. It was taken off. Right, exactly. It comes up every year though. So at some point, the way we're going, we might get there. If that happens, you're going to see a lot of available real estate in New York City, because again, our real estate taxes alone go up by more than 2%. You certainly, as New York
They're
City,
not going to go up 2% now. You got Mamdani as the mayor of New York. Property taxes are certain as no. Anyway, I'm sorry. I didn't mean to interrupt and jest.
He's talking about 2%. And certainly, Mr. Mondami doesn't want us to cap our pay increases to our
Employees.
managers by 2%. Nor do I. I want my managers to be the best paid managers in the industry and want to work for Safeguard. That's a big part of it. But you can't have your cake and eat it too. We have to have the funds to do it. Otherwise, we're gonna be out of luck.
Well, listen, I know you're so involved in that organization, and I think October is your show in the New York City area, and then of course the investment forum, which I've said many times.
We have one other one I want to throw out there. In June, we have our Upstate Forum. So for all of our Upstate listeners, it's up in the Great Lake area, Del Lago. It's a beautiful casino resort up there, and all are welcome.
Love it, love it, love it. And I'll have that details of it on the other show on Storage Unlocked as that gets closer. I'd be remiss in not saying NYSSA's coming up, the Northeast Self Storage Expo at Foxwoods in May. I will as well. So we'll have to sit down and break bread. And then the Mid-Atlantic Show down in National Harbors in June. So get involved. It's never been a more important time. And I just firmly believe as this industry consolidates, there are going to be less of those mom and pop owners that for many, many years were a lot of the lifeblood of the state organization. So more important for those of us that are involved in storage to get up and get involved. So we'll say super appreciative of what you've done and the role you've taken there. So that's greatly appreciated. I'm going to flip. We got like 1-2 minutes left. There's a topic that I wanted to get to. You were down in San Antonio. I couldn't go to the SSA, which I'm still heartbroken about, but couldn't be there. You stepped in for me with a couple other folks. I was able to get a bunch of consensus through my LinkedIn following, and thanks to everyone that did and chimed in. And the SSA set up a prayer breakfast. So I want to say thank you for being involved. And 6:30 in the morning on Thursday at the SSA is never an early time, as most people are out having networking dinners on Wednesday night. So I appreciate that. You came on How Faith Fuels Your Business, the segment that I do on Storage Unlocked, to talk about your faith, and folks can go find that on the YouTube channel without too much trouble. If you're not subscribed, youtube.com/@Storage Unlocked. You can see Stan's segment there. But you told me something there that struck me, and I want to talk about it a little bit. This past weekend was Easter weekend. Your son, 13-year-old, in my prayers, broke his radius and ulna, clean fracture in his forearm. Friday night, still made it to Easter service on Sunday morning. I want you to talk to me about your sons and the role that they had in Stan getting back in touch with your faith. This is something you and I have really bonded over in terms of coming back to our faith.
Yeah. It's a beautiful story, and I'm so blessed. So I grew up Christian. I've always had faith in Jesus Christ as my Lord and Savior, and I'm not afraid to say that, and I get excited to say it. But we go through peaks and valleys in life, and I stopped going to church. I never lost my faith. Growing up with my boys growing up, we always read the Bible together at night, and every morning on the way to school, we'd listen to a chapter of Proverbs. There's 31 chapters. So each day we'd listen to a new chapter. And it was a beautiful way to share my faith with them and guide them in faith. But we weren't going to church. And I have a men's study every Friday morning at 8 a.m. And this came up exactly. And my youngest son, Chase, my youngest, who broke his arm, 13 years old, a few years ago, got turned on to The Chosen, the TV show. And he asked me to watch it with him. I watched it and we were blown away. It was so good. It touched him so deeply and drew him to Christ so firmly that he's like, Dad, why don't we go to church? I said, okay, let's start looking. So we started, and I wanted a local church where we could find families in the neighborhood also, so that way they could take it to their school as well. I think that's important. And we went to a few different churches, and the last church we went to was Grace Reformed Baptist Church of Long Island. And we went there the first day on a Sunday afternoon. And afterwards we looked at each other and we were like, we found it. It was, we talked about it. I said it to you, the 5 solaces: faith alone, Christ alone, through grace alone, through scripture alone, and to the glory of God alone. And that's the foundation that church is built on. And that's the foundation that I want my boys to really grow in. And they were baptized in January, and we've been going there since for over a year now.
Absolutely love it.
Yeah, it's a beautiful story.
Today for me was day 100 of 2028 of my journey through the New Testament, which I do daily, which is my second year of going through the New Testament. You're motivating me because I got to get my butt back into a consistent habit of getting to church every Sunday morning. So I appreciate that.
The important thing about that, we talked about the association. We're called to be social, and we're called to help each other, and we're called to serve each other. It's put your money where your mouth is, right? It's one thing to believe it. It's another thing to do it. And you go out there and you do it, and you do it with other people, because in the community, the church is the bride of Christ, right? It's not one of us individually, but it's all of us together collectively. And he loves us, and he loves us as if we were his wife, and we ought to love him as if he were the church's husband. So I encourage you, and I encourage everybody out there to get to church on Sunday.
You give me tingles. John 8 today was Jesus talking to the Pharisees and saying that if you knew my Father, you would love me, right?
Yeah.
And so, hey, Stan, I love you. Cannot thank you enough for coming and joining me. I can promise you that the reason people call you the man is not just because it rhymes with Stan, although that might have a little bit to do with it. There's much more depth to that. He's Stan Bonilla. He's buying self-storage assets. He's looking for prime development deals. You can reach out to him at Bonilla at SafeGuard, as you saw on the screen there. Thank you so much again.
And he's going to give a quick shout. You're best in the business.
I appreciate that, man. You're way too kind. There aren't that many people doing podcasts in self-storage, so I'm a little bit of a unique space, but that's all right. I'll take I appreciate the kudos. Going to give another shout out to my friends at Kiwi 2 Construction. Without them, I wouldn't still be doing this podcast. Wayne Woolsey is absolutely the man. Him and his team, he and his partners started in 1991, put up their first self-storage building. So kiwiconstruction.com. You can reach out to them. Touch base with them early in your process. The earlier you get a hold of them, the more they can save you money by understanding where are going to be the best ways for you to get something built. As Stan so aptly told you today, it's getting harder and harder to build self-storage. Get them on board early. Kiwi 2 Construction. He's Stan Bonilla, SVP of Asset Management and Development. He's got a couple of titles at SafeGuard. I'm Thaddeus Campbell. That's it for this week's episode of Stories Behind the Door podcast. Thanks for watching.
Thaddeus, you're the best.